Hello, welcome to this course on technical analysis. Actually, this is a subset of technical analysis called indicators. And in this course, we'll be discussing moving averages. Moving averages are the trend trader's most trustworthy friend. Averages are used everywhere in our day-to-day life. From monthly expense averages to cricket run matches averages, they help us get a sense of a realistic future. Now, we could guess or try to gaze into a crystal ball, but that is a gambler's mindset. Instead, we can use averages to make an informed prediction about future value. Say in a cricket match, a match winner batsman will calculate the average between the total runs required to win and the overs remaining. He will eventually keep the run rate moving a little above the average, and we will win that match without taking much risk. Whereas a newbie or a premature batsman will only look at the runs required and will try to get out trying to hit those sixes as soon as possible, without keeping the average game in mind. The same logic works well with the stock market. Now, Hindustan Unilever has products which are used by many households in India. This has resulted in the company growing every single year non-stop, and you can see this growth reflected in the weekly charts of the company below. Now, there is a whole lot of price data here, right? The market goes up, then it goes down again, then up again. But overall, you can see that the market is moving up nice and gradually. Now, what if we just calculated the running average of the price, just like that batting average? We would get this, a moving average. Also, I need you to notice how price comes back to it and then bounces right back up, just as if price needs to come back to the average or the mean and then bounce and move towards exuberance. Interesting. You see, markets are an emotional reflection of the masses. People get overexcited, then really depressed, causing stocks to either fly like there is no tomorrow or fall as if there is no yesterday. Now, if the company's fundamentals are good, like this company, then the price will usually come back to its average and then continue to rally. Cool, right? Now let's talk about how the moving average is calculated. The clue is in the word. It's an average which keeps on moving. So basically, the average price movement is added every single day, which is why we call it a moving average. So let's suppose we want to draw a 20-period moving average in, say, this chart, Hindalco Daily. The indicator will plot the average of the closing price of the last 20 days. Moving averages work best when used in longer time frames. And luckily, I'm not going to show you a nice math formula because we have computers to do that. Moving averages are standard across all charting platforms. All you need to do is put in how many periods or days of the moving average you actually need. Moving averages with a higher period will react slowly, smoothly. They take their time. They're very graceful, you could say. And moving average which have lower periods react very fast. For example, let's add one moving average to our Hindalco chart with a higher period, let's say 50. The blue line is 20-period moving average and the red line is a 50-period moving average. You can see that the red one, which is the higher period, moves much more slowly when compared to the lower time period, that's the blue line. You will see that at certain points in August, the blue line actually pointed north, indicating that we're moving upwards, but the red line was still tipping downwards. This is why it's always a good idea to have higher time frames and a higher moving average. Now, traders use moving averages to spot the current trend of a stock. Now, if a moving average is generally moving up, we can say with confidence that the stock is in an uptrend. Here, let's see Dr. Reddy's really quickly. This is a 20-period moving average drawn on its chart. Now look at the way the moving average line is on a steep upward move. Look at the distance price has maintained with the moving average line, suggesting a strong bullishness in the stock price. And when the moving average line moves downwards, maintaining distance with the price, that's called a downtrend. This can be seen very easily. You may not need an indicator, but we'll get to how to use the moving average in just a bit. In the Hindalco chart, with the 20 moving average, we can see the same thing. The price is trading below, it keeps a distance, suggesting a strong downtrend. A steeper angle, the stronger the move. And if moving average is flat and price continues to cut it again and again, it suggests, obviously, a sideways market. Now, trades based on moving averages do not work well in sideways markets and give a lot of whipsaws that are false trades. That's the reason moving averages are called the trend's best friend. Trend traders will always have problems during sideways markets, such as this company. Now, moving averages also provide support and resistance in trending markets. Look at Dr. Reddy's chart below. Price comfortably trades above the moving average line. Suddenly, it comes down and closes below it. However, after a couple of days, it closes back up the MA line and continues its bull run. It's called a rejection of moving averages. Price here took support and then gets its strength to make new highs. This is a very common occurrence. Same can be seen in the Hindalco charts. After a nice down move, price reverses in the direction to move up, touches the moving average line, gets rejected closing below the MA line, and continues its down move. This also is a very common occurrence. This sort of rejection in a trending market gives us our entries in the stock with less risk and a higher reward. We'll talk about it in our second lesson, playing support and resistance with moving averages. Thank you for watching this lesson. The next segment is going to deal with support and resistances with moving averages. I'll see you again.